Yeah, hi, this is Mike Lembeck with the Remax Commercial bringing you today's Let's Talk About It. Today's background video is the just some scenery from around the world, different places around the world. Very beautiful scenery. Hopefully you enjoy it. Don't forget to like and subscribe to the channel, and I look forward to seeing you on future videos. And let's get into it. Okay, today's article that we're going to be reviewing is the apartment rent growth is set to keep slowing this year. This is for, of course, 2023, moving forward in 2023. The pandemic fueled boom for multifamily building owners is fading fast going into 2023. We have apartment vacancies are piling up, and the biggest wave of new rental buildings in nearly 4 decades is expected to cut the pace of rent growth across the country. So we've got a lot of new building being done. A lot of that is going to be coming on the market for prospective tenants to choose from in most areas, including Southern California. We've seen building going on in some of the uh, almost high-rise buildings that have been built throughout the county of Orange. And I know you probably have seen them, the construction and stuff as driving around while you're going back and forth to work, different places, appointments, that type of thing. They have been building them for the last couple of years. So the rising interest rates, meanwhile, make rental property investments less profitable than 1 year ago when debt was cheap and hefty rent increases were taken for granted. So again, the rising interest rates are having an effect on the overall market, not only just for uh, the new debt, but is also having an effect on rent increases as everyone was able to just have that inexpensive money and as far as borrowing the for loans, and you could raise the rents and just keep increasing them with that low cost of money. Then we have of the 44 million households that rent, more than 19 million spent 30% or more of their income on rent and other housing costs. So 30% is typically kind of the minimum of what you would want a tenant to pay as far as their monthly income towards rent. So anything over that is going to be something that is not affordable for a tenant. And a lot of tenants, they're looking at 40 to 50% of their income is going towards rent. The early lockdowns created a pent-up demand for housing, and many young people went out to rent their first home, and the sudden increase in people searching for apartments helped rents climb 25% over 2 years. So they had a lot of new renters coming back into the market after the lockdowns for COVID, and that caused those increase in demand, which of course helped fuel the increase in rents of 25% over the last 2 years. And then nearly 500,000 new apartment units, the most of any year since 1986, are expected to complete construction by the end of 2023. That will come after more than 400,000 units were completed during 1922, according to an analysis by property data firm CoStar Group. And the addition of so many new apartments to slowing housing markets is expected to keep a lid on rent growth. So that's how many units we're going to be having coming to market. This is, of course, nationwide, but it's still going to affect us here locally in Southern California. All that new inventory for tenants to choose from. And some cities with higher than average construction activity could see full year rent declines. I don't see us having any full year rent declines or any rent declines at all in Southern California, just because I think there's just a strong demand, mostly in the coastal areas, for tenants that they want to live in the areas closer to the beach. So you're going to have a lot of demand throughout Southern California, and I don't see us having any rent declines, but definitely we'll have a slowdown in the amount or the percentage of rent increases. Amid rising concerns of a recession, many housing economists don't think job and wage growth will be strong enough to sustain much in the way of rent increases this year. Both Yardi and Moody's expect rents to rise about 3% nationally during the next 12 months, less than half the rate seen in 2022. So 3% is what we're anticipating nationally from Yardi and Moody's. They're two of the good forecasting companies out there as far as for economic news. And if we have a recession, which more than likely we will have this year, if we're not already in one, then we will see the job and wage growth won't be strong enough to sustain any new rent increases. I think tenants are pretty much maxed out on what they can pay now, and then we're seeing a lot of doubling up, a lot of tenants moving back home with mom and dad just to kind of save money and just be able to weather this recession that we're in currently. If there is a recession, history shows that the rental sector handles bear markets better than other markets or other parts of the economy where consumers are more likely to cut back their spending. Rents eat first, so the tenant is going to be paying that rent, and then they're going to be looking at other ways to cut their expenses besides rent. Again, they may end up doubling up. They may end up moving back with mom and dad, or just moving in with relatives to save money and not have to pay such high rents. And in 2021 and early 2022, you could raise rents significantly without doing a lot to the property itself. We don't see that happening going forward. So you didn't have to, there was such a demand that you didn't have to go in and fully rehab the property. You could do some of the improvements that might be necessary to get the property rent ready and get a tenant in there. Now we don't see that going forward because there's more competition out there with more inventory. And then borrowing the money to make investments in existing rental properties, such as renovating them to be more attractive to higher paying tenants, has become more expensive because of rising interest rates. Sales of apartment buildings are falling as a result. Building sales in November, as measured by total dollar value, were 70% below their levels during the same month the previous year. And this is according to a report by MSCI Real Assets. And in that same report, the incentives for apartment investing have changed. So we're now down at 74% below the levels of what we were last year at this time for sales. So there's been a big pullback with the interest rate increases and then the potential for having the tenants or having the rent increases not as easily obtainable. So if you have any questions on any of the information here, or if you need any help as far as rent survey, a market analysis on your property, anything like that, I'd be happy to help you. Any other questions regarding real estate? I'm here to help at any time in anything that you might need. So take a minute to make a comment and make sure you subscribe and like the video, and look forward to seeing you on the next one. Take care and have a wonderful day.